Hello to all of our viewers and welcome back to another Talking Point. Now, for those of you still new to the channel, you happen to stumble into a whole new world of education where we're going to help and guide you through the world of investments and asset protection. And today's talking point, we're going to be looking at the massive leap we've seen this year in the interest rates, which has without a doubt made a massive dent on everyone's pockets. But as we always say, if you're invested in the right places, then we can be smart and work around the challenges. And here at Wealth Masters Club, we always have innovative ways to find new solutions to any problem. So if you've been following us for a while, then you'll know that our core focus is, of course, in property investment. And this is obviously one of the hardest hit investment classes when the interest rate increases. But with the right experts on your team, you will see that selling an investment property isn't always the only option or solution to the problem. So to talk a little bit more on this point is our in-house property expert, Emile Grobbelaar. So Emile, thank you so much for joining us today. We really appreciate your time.
Damien, pleasure, as always.
Now, Emile, it almost seems like a distant memory when we think back to the interest rate being at 7% during COVID times. But now, at the time of recording this interview, we're sitting at a massive 10.5%. A lot of investors in the property game may be tempted to sell, but according to you, there are several ways to beat the inflation. And one of the suggestions you made was to acquire a cash flow positive property. So how would one go about determining whether the property will in fact be cash flow positive? And what are the sort of things you'll be looking out for?
Obviously, if you want cash flow, the net return on the property needs to be as high as possible. And those type of properties, second-hand properties, are difficult to find. I find that most of them, net return-wise, compare with the very good developments that we have, new developments that we have available. So you're going to take some time to find the right property, but the net return needs to be as high as possible. I always work on the ROI rather than the RVR, the rent value ratio, because the ROI takes the cost into consideration, which is obviously your levies and rates. They are being escalated year on year. So high as possible net return on a second-hand property, I would say you'll probably start seeing a positive cash flow from 12% upwards net. And then as well, you need to factor in the interest rates that will rise next year as well. They predict another 0.75% early next year. So if you do work on prime, which is the 10.5% now, escalate it and work on perhaps an 11.5, just to cover yourself as well for the future escalations in interest rates, so that this property that you are buying, which is supposed to assist on the shortfalls of other properties, will not move into a negative cash flow in the near future as well.
And Emile, you also mentioned refinancing to settle a bond, which to some people may seem a little bit counterintuitive. So can you give us a little bit more information about what you actually mean there?
Yes, Damien. It's funny. I had a client phoning me about that as well. If you do refinance a property, let's say you're able to take R500,000 out of that property on refinance, and you settle another bond. The bond that you are settling could be, let's call it R1 million bond. So your repayment on that bond is the monthly installment in 10,000 Rand per month. So if you settle that, then you lose the expense of 10,000 Rand, where your increased expense on the 500,000 that you refinance on the one property will only increase by, let's say, 5,000. So you will definitely be to the positive of 5,000 Rand, just to use a simple example. So you are relieving a bond, an expensive bond. It doesn't matter if the outstanding balance is only 500,000, but the installment is in line with the initial bond amount, which was 1 million Rand. So you settle it, and that whole installment gets removed from your expenses in your portfolio.
Then you also highlighted a SARS initiative in your article, namely Section 13.6, which most people are absolutely unaware of. So can you just take us through this actual amazing benefit that SARS has put out there and how it can
Yeah.
benefit the property investor?
Yeah, very, very important thing. That's one of the reasons why we currently still look at new developments to acquire most of the time, because as soon as you start doing that 13.6 tax claim from SARS, it more than doubles your net return. So the conditions are that you need to own a minimum of 5 brand new properties, brand new. You're the first owner, bought directly from the developer. Doesn't matter how long it takes for you to reach to number 5, but when you do, then you can start claiming back 55% of the cost, the purchase prices of those 5 apartments or properties from that point onwards. So a lot of people misunderstand what happens. It's not cash that you're getting back from SARS; it's a tax reduction, and it is being claimed over a period of 20 years. So if your 55% is worth 5 million rand, for instance, then the 5 million rand will be claimed 5% per year over the next 20 years. So if you do need to pay tax, then that amount, which whatever amount it equates to, gets deducted as well on the tax claim. So your tax payable will be less, and that obviously will increase your cash flow as well.
And then one thing that I think people overlook a lot of the time is rent escalation. So I think most people think it's standard things when it comes to a rental agreement, but evidently not. So what is your advice in a case where you have an amazing tenant who requests no rental increase?
Damien, yes. Good tenants are gold for us, for investors. Unfortunately, we've gone through a very bad time, specifically in Gauteng, where there were rental reductions even, or zero escalations, all for the reason to keep the good tenant, which in that case is acceptable because the market is tough. There's in Gauteng specifically too many properties available for the tenant to rent, and the rental rates are down. But if you're in a strong market like Western Cape at the moment, you need to escalate according to the market. If the market is like that and your tenant refuses to do an escalation, then you can let them go because you will find another tenant. But if the tenant is a very good tenant, instead of escalating 8%, do a 6% or 5%, but do escalate. They must pay more. If they're not willing to pay more at all, then rather get rid of them. You will find another good tenant. And I'm referring specifically to the strong market in the Western Cape at the moment. In Gauteng, different story. If they don't want to escalate at all, push it up by 200 Rand, 300 Rand, but do something. With a good tenant in the Western Cape market, the strong market, if they're pushing you down for 2 or 3 consecutive years, then you're going to be way behind the market. The market escalates at 8% in the Western Cape, even 10%. So if you carry on at your 4, 5, 6%, you will be way, way, way below the market, and you are losing money, and that is your own fault. So if the tenant by year 3 tells you, I'm not going to escalate, and you say, thank you very much, please find another place, you will probably be able to get a much higher rental from the next tenant that you put into that property.
Now, the point that most people want to turn to when it comes to turbulent times is, of course, selling property. So what are your thoughts on this during the current economic climate?
Now, Damien, as an investor, you never want to sell your investment. Things has to really, really become bad before we would consider selling a property. I would rather, like we mentioned previously, refinance the property, take the money, take the capital out of the property, settle another bond or reduce another bond to increase your cash flow. Then you still have your asset. You haven't lost your asset. So that is really, it's not really a strategy if you are able to take capital out of the property. But if that is not the case, the very, very last resort is, yeah, maybe to sell it. You will lose the debt. You will lose that monthly expense, which will then benefit your cash flow in your portfolio. But then you need to obviously sell the right property as well to create the positive cash flow in your portfolio. And that might cause you to sell one of your best properties. It might be one of the best performing assets that you have. So that is not a good thing for an investor to lose his best asset or best performing asset. So I would really, really, very, very last resort go that route. Otherwise, I would refinance whatever I can to settle something else, which will give me the better cash flow and I can maintain and retain my asset.
And then any other advice that you can give to our viewers during this time?
Damien, yeah, I would say keep an eye on the interest rates all the time and your cash flow in your portfolio. You must, as soon as there's a increase in rate, assess your cash flow the next couple of months just to make sure that you stay on top of what your portfolio is doing and the performance there. With us, that we buy in trust, ownership in trust. Sometimes we need to invest money from our personal pockets into the trust to carry the shortfalls. But if that is not the case, and you're not used to doing that, then at some stage your debit orders for your bonds will start bouncing in your trust because the properties are moving into a negative cash flow situation. So if you don't keep an eye on that and you don't push money into the trust account where the bonds are being paid from, then your debit orders will start bouncing and will negative your credit score, influence your credit score negatively, and that is a big, big, big impact. If any debit order with regards to bonds are not being paid, then the banks will not look at you positively when you're trying to buy another property. So that is very important.
Emile, thank you so much. Now, there's one thing that I just want to make very clear. While the principle is that we share our videos, trainings, and online, everything we do is not exclusively for investors. So the core of what we do is the creation and management of specialized trusts, and that'll protect your family's assets. Now, you may be thinking, why is that important? Well, when a spouse passes, their estate will be frozen and subjected to what we call death taxes, which could eat away at more than 60% of your asset value. But if your assets, such as your family home and investments, are in a specialized trust, then you will be not subjected to this because this is not your own asset. So if you want to educate yourself and be in a position of power where you can protect your family after you're no longer there, then register for our next online training and see how we do and what we do. We've been educating people all over the world for almost 20 years and have helped thousands of people to structure their finances in trust. So we do what we do because it is our mission to help and to educate and to provide clarity where our education system has let us down. So check out the link in the description and you will see what our next training will be, and be sure not to miss it. That's all we have time for today. Emile, once again, thank you so much for your time. I think your
Okay.
little bit of education today has gone a long way to help people see the interest rates increase in a very different way. So thank you so much for that.
Only a pleasure, Damien. Thank you.
Right, until next time, we'll see you guys then. Bye-bye.